capital budgeting techniques. These are techniques that are applied while undertaking investment decisions. You do remember in our introduction, we said that uh, financial management has four main core functions. That is financing decisions, which we covered in topic 2. Then we have investment decisions, which we cover in this topic. And then we have dividend decisions, we cover later, and working capital decisions. So in our case here in this topic, we look at investment decisions which are met by undertaking capital budgeting techniques. So what is capital budgeting? Capital budgeting is an investment appraisal process that is used to determine whether a business's long-term investments are worth funding, or whether a business's long-term investments are worth being made. Yeah, so you undertake capital budgeting to analyze investment projects. So to determine whether to invest in a project or not. So capital budgeting tools, we have two main classes of capital budgeting tools. That is non-discounted cash flow techniques and the discounted cash flow techniques. We begin with the non-discounted cash flow techniques, which include the payback period, PBP, and the accounting rate of return, ARR. So these two techniques are referred to as non-discounted cash flow techniques because they do not take into consideration the concept of time value of money. They don't take into consideration the concept of time value of money, which means that they do not discount their future cash flows into their present value cash flows. So payback period and accounting rate of return does not discount the cash flows of an investment. Whereas for the discounted cash flow techniques, we take into consideration the concept of time value of money. We discount the future cash flows into their present value cash flows. Under the discounted cash flow techniques, we have the net present value, NPV, we have the profitability index, PI, and we have the internal rate of return. So we move into the details. So for us to move into the details, we shall apply the following example. So a company is considering two mutually exclusive projects requiring an initial cash outlay of 10,000 shillings each, with a useful life of 5 years. The company's required rate of return is 10%, and the cash flows are expected to be generated by the project as follows. So you have the 5 years, and the cash flows for project A is 4,000, 4,000, 4,000, 4,000, and 4,000, and for project B is 6,000, 6,000, 2,000, 5,000, and 5,000. So required, calculate for each project and advise. So 1, we calculate the payback period, 2, the average rate of return, 3, the net present value, 4, the profitability index, and 5, the internal rate of return. So please take note of the key items in this project because we may not come back to this page. So the key items in this project is that 1, there's an initial outlay of 10,000 shillings. The project lifespan for each of the project is 5 years, and the discounting rate or the required rate of return is 10%. And those are the cash flows of the two projects. And then this is what you're required to do. So you begin with the first capital budgeting technique, that is the payback period. This is a non-discounted cash flow technique. It doesn't take into consideration the concept of time value of money. So what is a payback period? So this is a period of time it takes a project to recoup its original investment. The period of time a project will recover the money invested into it. So if you have invested 10,000 shillings, how long will it take you to get back 10,000 shillings from that project? So the period of time it takes is the payback period. So with payback period, we prefer those projects that have the shortest payback period. So the shorter the payback period, the better. So back to our question. So you compute the payback period of project A and project B. So you begin with the payback period of project A. So to get the payback period of project A, so we arrange the cash flows as follows with their years. So the years 1, 2, 3, 4, and 5. And then the second column, we have the cash flows for each year. So in our case, for project A, year 1 had cash flows of 4,000, year 2, 4,000, year 3, 4,000, year 4, 4,000, year 5, 4,000. And then we take the cumulative cash flows. Yeah. So the cumulative cash flows for year 1, the cumulative cash flow will be 4,000 shillings. For year 2, the cumulative cash flow shall be 4,000 plus 4,000 cash flow of year 2, which gives us 8,000. So 8,000 shillings is the cumulative cash flow at year 2. At year 3, the cumulative cash flow shall be 8,000 plus 4,000 cash flow in year 3, which will give us 12,000. For year 4, the cumulative cash flow is 12,000 plus 4,000, giving us 16,000 shillings. And then for year 5, the cumulative cash flow is 16,000 plus 4,000, which gives us 20,000 shillings. So we compute the cumulative cash flows during by the end of each year. So once you get the cumulative cash flows, then you're able to tell at which point the business recovered its initial investment. So remember that the initial investment is 10,000 shillings. So looking at these cash flows, at what point will the business recover the 10,000? In this case, we're able to identify that it is in the third year. It is in the third year that the business will get its 10,000 shillings. But in this case, since by the end of the third year, the business will have acquired 12,000 shillings in total, to recover, you only need 10,000 shillings. So the third year will not be taken as a whole. It will be taken in part. So therefore, in our case, the payback period shall be equal to the 2 full years, that is year 1 and year 2, plus a portion of year 3. And a portion of year 3 shall be equal to the amount remaining to recover the full amount, which is in this case is 10,000 minus 8 recovered in year 2, which will give us 2,000 shillings, divided by the cash flow in year 3, which is 4,000 shillings. So this will give us 2 years and a half, so 2.5 years. So therefore, 2.5 years is the payback period of project A. Another thing to note is that when we have an annuity, the payback period shall be equal to the initial outlay divided by the annuity. So what is an annuity? An annuity is a constant amount that occurs regularly. Yeah, like we receive the same amount of cash flow for regularly. Yeah, so every year we receive a fixed amount of money. So that fixed amount of money is the annuity. So in our case for project A, we have an annuity of 4,000 shillings because year 1 is 4,000, year 2 4,000, year 3 4,000, year 4 4,000, year 5 4,000. So this becomes an annuity, a fixed amount, a constant amount per period. So when we have an annuity, we may not go through this process of getting the cumulative cash flows, but rather divide the initial outlay by the annuity. So in our case, the initial outlay being 10,000 shillings, the annuity being 4,000 shillings. So therefore, 10,000 divided by 4,000 shillings will give us a payback period of 2 years. So this is the same as the payback period when using the cumulative cash flows. So it confirms that our procedure is correct, that the procedure of computing the payback period is correct. Then we do the payback period of project 2 of project B. The payback period of project B, allow me to maximize this. For project B, the payback period of project B So these are the cash flows as per the question. So year 1, 6,000, year 2, 3,000, year 3, 2,000, year 4, 5,000, and year 5, 5,000. So we get the cumulative cash flows. For year 1, the total cash flow received from the project is 6,000. Year 2, the total amount received from the project is 9,000. Yeah, so that is 6 plus 3. Year 3, the cumulative cash flow is 11,000. That is 6 plus 3 plus 2, or 9 plus 2. Year 4 is 16,000, which is 6 plus 3 plus 2 plus 5, or rather 11 plus 5. And year 5, the cumulative cash flow is 21,000, which is 16 plus 5, or rather 6 plus 5 plus 3, 6 plus 3 plus 2 plus 5 plus 5, giving us 21. So our initial outlay is 10,000 shillings. So how long do we need to recoup the 10,000 shillings? So in this case, we can tell that the recoupment will be in the third year, but you do not need the entire of that third year, because by the end of the third year, the business will have recouped 11,000 shillings. So you do not need the entire of the third year. It's only a fraction of it, a few months. So therefore, our payback period shall be equal to 2 years plus a portion of the third year. The portion of the third year is equal to the amount remaining in the third year to recoup the total amount, which in this case is 10,000 minus 9. Yeah, so 10,000 minus the total amount received by year 2, that is 9,000, which will give us 1, divided by the cash flow of year 3. So the cash flow of year 3 is 2,000 shillings. That will give us 2 years plus 1,000 divided by 2, which is equal to 2.5 years. So in this case, the PBP of project B is 2.5 years. And the PBP of project A is still 2.5 years. So in this case, our decision will be, our projects have the same PBP. So therefore, in difference, we can choose any based on payback period, because each give us the same payback period. So that's the payback period. It has the advantage of being simple to calculate. It has the advantage of also being easy to understand and easy to apply. But the main advantage of payback period is it ignores cash flows after the payback period. So the cash flows may start declining in the payback after the payback period. The business may be making losses after the payback period, but PBP ignores that. So the major problem with the PBP is that it ignores after payback period cash flows. We move on to the next capital budgeting technique. We move on to the next capital budgeting technique, that is the accounting rate of return. So this method takes the average accounting profits to the average investment. So the average accounting profit, the average investment. So therefore, the formula of getting the accounting rate of return is equal to the average accounting profit divided by the average investment. So the average investment is equal to the initial investment plus the scrap value divided by 2. So the average investment is equal to the initial investment plus the scrap value divided by 2. Decision criteria under the accounting rate of return, we prefer projects that have the highest accounting rate of return. So projects with the highest ARR are preferred. So we go back to our question. We compute the ARR of project A and the ARR of project B. So the ARR being the average accounting profit divided by the average investment. So in our case, as per the question, we have not been given any further information to tell us whether those cash flows are profits or not, or any information to adjust the cash flows to make them profits. So we take the cash flows we've been given to be the profits from the project. So therefore, the average profit, which is the mean, is equal to all the cash flows from the project divided by the number of years. So in our case, 4 plus 4 plus 4 plus 4,000 divided by the 5,000 to give us the average profit of 4,000 shillings. And the average investment will be equal to them. As you said, it's the initial cost plus the scrap value divided by 2. The initial cost of the project in this case is 10,000 shillings. The scrap value haven't been given, and then we divide that by 2 to give us 5,000 shillings. So therefore, we can now calculate the accounting rate of return, which is equal to the average accounting profit. We've seen it's 4,000 divided by the average investment. We have seen it's 5,000 multiplied by 100 to give us 80%. Then we move on, and again, remember in the assignment that I gave you, suppose you've been given cash flows and some additional information. That additional information is to assist you to obtain the accounting profits. So in that question, you're supposed to obtain the accounting profits and to use them in computing the accounting rate of return. So we move on to the accounting rate of return of project B. So we get again the average profit. So the average profit is basically the sum of all the cash flows divided by the number of years, which will give us 4,200. That is 6 plus 3 plus 2 plus 5 plus 5 divided by 5 will give us 4,200 shillings. And then our initial, our average investment is still the same as for project A. So the initial cost plus the scrap value divided by 2 is 10 plus 0 divided by 2, which gives us 5,000. So 4,200 divided by 5,000 will give us 84%, being the ARR of project B. So therefore now, what is our decision? So our decision is invest in project B since it has the highest ARR. So for the internal rate of the accounting rate of return, we prefer those projects that derive the highest accounting rate of return. So in our case, project B emerges the winner. So you should invest in project B. So we move on to the next capital budgeting technique. That is the net present value. So the net present value is a discounted cash flow technique that takes into consideration the concept of time value of money. So this is a discounted cash flow technique which compares the present value of cash inflows against the present value of cash outflows. So it compares the present value of cash inflows minus the present value of cash outflows. So we have its formula here. So the NPV is equal to the present value of cash inflows minus the present value of cash outflows. So cash inflows are those that come in that are generated by the project. Cash outflows are those that move from the business going out in order to invest in the project. So the net present value, the decision criteria is we prefer those projects that have the highest NPV. So in short, the higher the NPV, the better. So the decision criteria go further and say that whenever the NPV is greater than 0, that is for a single project, we accept the project if the NPV is greater than 0. If the NPV is less than 0, we reject the project. We do not invest in the project. And when the NPV is equal to 0, we're indifferent. Yeah, we can choose any of the projects because okay, yeah, when the NPV is equal to 0, it becomes quite difficult to use the NPV as a decision tool to help us in making a decision on whether to invest in the project or not. But when the NPV is greater than 0, accept. When less than 0, reject the project. So we move back to our question and calculate the NPV. So to get the NPV, we discount the cash flows. Yeah. So to discount the cash flow, we multiply by 1, by in brackets 1 plus the interest rate raised to the power of -n. So we multiply by 1 by in brackets 1 plus the interest rate. So in our case, the equation gives us the rate of 10%. So 1 plus the discounting rate multiplied raised to the power of -n. So in our case for year 1, the cash flow is 4,000 shillings. Our present value interest factor for year 1 is 1 plus 0.1 raised to the power of negative 1, which goes with the year, negative 1 year. So this one, 1 plus 0.1 raised to the power of negative 1 will give us 0.9091. So we multiply 0.9091 times 4,000, it will give us 36. We move on to the second year. Our cash flow is still 4,000 shillings. We multiply by 1 plus 0.1 in brackets raised to the power of negative 2, which goes with the year of the cash flow. It gives us 0.8264. So we multiply 0.8264 times the cash flow for that year. It will give us 33.08. We move on to the third year. The cash flow is 4,000 shillings. We multiply by the present value interest factor at 10% for 3 years. That is 1.1 raised to the power of negative 3, which gives us 0.513. We multiply 0.57513 times 4,000. It gives us 3,005. We do the same for year 4 and the same for year 5, and then we add those present values. Yeah, these are cash inflows. So we add these present values, it will give us the present value of cash inflows. So in total, the present value of cash inflow is 15,165. 15,165. And the present value of cash outflow is 10,000 shillings. Yeah, the cash that has been used at the present at time 0. Yeah, so any number to the power of 0 is 1. Yeah, any number to the power of 0 is 1. So you multiply 10,000 times 1 plus 0.1 raised to the power of 0 is 1. So there is no point of discounting the present value of cash outflow because the discounting factor shall be 1. So as such, there's no point of discounting 10,000 shillings. So therefore, our present value of cash outflow is 10,000 shillings. So our NPV in this case is the present value of cash inflow minus present value of cash outflow, which is equal to 15,165 minus 10,000, which gives us 5165 as the NPV of project A. Again, we noted that project A has an annuity of 4,000 shillings. When we have an annuity, we may avoid this process of computing the NPV, but rather we may use the present value interest factor of an annuity. Yeah, we may use the present value interest factor of an annuity at the rate of R for the particular period of time. So in our case, the present value interest factor of an annuity at the rate of R for n number of years is equal, the formula is equal to 1 minus, in brackets, 1 plus the interest rate raised to the power of n, and then we divide the whole of that by the interest rate. 1 minus, in brackets, 1 plus R raised to the power of negative n divided by the discounting rate. So in our case, we have 1 minus 1 plus the interest rate, which is 10% or 0.1 raised to the power of the number of years of the project raised to the power of negative 5 divided by the interest rate, which is 0.1. So it gives us 3.7908. So this present value interest factor of annuity, we multiply it by the annuity to get the present value of the annuity. So in our case, the annuity times the present value interest factor of the annuity at the rate of R for the n number of years. So the annuity is 4,000 shillings times the present value interest factor of the annuity, which in our case is 3.7908, which gives us 15,163, which is now the present value of the annuity. That is the present value of cash inflow is 15,163. Then our NPV shall be equal to the present value of cash inflow, that is 15,163, minus the present value of cash outflow, 10,000, which gives us the NPV being equal to 5163, which is more the same as 5165. We only have a difference of 2 shillings, which is very insignificant. But which is very insignificant, but close to each other. It's only that we lose the accuracy when we round off especially these figures. Yeah, when you round off, we lose the accuracy. So since in the second part you've not rounded off as much because you've only rounded off one figure, as opposed to the first approach where you rounded off all these cash flows. The second approach will give us a more accurate answer. So in this case, 5163 is more accurate as a NPV of project A. And then we compute the NPV of project B. So we multiply each cash flow by its present value interest factor. The present value interest factor is 1 plus the interest rate raised to the power of n, the year in which this asset was, this inflow was experienced. So in this case, for the present value interest factor of year 1 is 1.01 raised to the power of -1. For year 2 is 1.01 raised to the power of -2. For year 3 is 1.01 raised to the power of -3. For year 4 is 1.01 raised to the power of -4. And for year 5 is 1.01 raised to the power of -5. So the present value interest factor, once they are done, they'll be as follows. So for year 1, 1.01 to power -1 is 9.01. The same case with, say, for year 5, 1.01 raised to the power of -5 is 0.6209. Then to get the present values, we multiply each cash flow by its present value interest factor. So for year 1, it's 6,000 times 0.901, which is 54.55. For year 2 is 3,000 times 0.8264, which gives us 24.79. So we do the same for year 3, for year 4, and for year 5. And then we add these present values. They'll give us the present value of cash inflows being equal to 15,956. So, and then we deduct the present value of cash outflow, which in our case is only 10,000 shillings. And then we get our NPV being 59.56. So in our case, project B is not an annuity. So therefore, there's no shortcut. We have to go through the entire of this process. So the NPV of project B is 59.56, whereas the NPV of project A is 51.63. So therefore, project B has a higher NPV. We should therefore invest in project B since it has a higher NPV. Then we have our second discounted cash flow technique, that is the profitability index, the PI. So this is another discounted cash flow technique, which is the ratio of the present value of cash inflows to the present value of cash outflows. So the present value of cash inflow is the ratio of the profitability index is the ratio of the present value of cash inflow to the present value of cash outflow. So its formula is equal to the present value of cash inflow divided by the present value of cash outflow. So the decision criteria and the profitability index, we usually prefer those projects that have the highest profitability index. So therefore, the higher the profitability index, the better. So the decision rule and a PI is we accept a project if its profitability index is greater than 1, and if its profitability index is less than 1, we reject the project. We do not invest in a project if its profitability index is less than 1. So the profitability index of project A is equal to the present value of cash inflows of project A. Back to our question. So the profitability index of project A is equal to the present value of cash inflow of project A divided by the present value of cash outflow of project B, of the same project. That is 10,000 shillings. So we had obtained this figure when calculating the NPV. The present value of cash inflows of project A is 15,165, and the present value of cash outflow of project A is 10,000 shillings. So you divide 15,165 by 10,000 shillings, it gives us 1.5165 as the present value, as the profitability index of project A, sorry. For project B, the profitability index is equal to the 15,956, which is the present value of cash inflow of project B, divided by the present value cash outflow of project B, which is 10,000 shillings still. So we had obtained this figure and doing the NPV, 15,956 as the present value of cash inflow of project B. So we divide this 15,956 by 10,000 shillings, it gives us 1.5956. So project B has a profitability index of 1.5956, whereas project A has a profitability index of 1.5165. So project B has a higher profitability index than project A. So we said that for profitability index, we prefer those projects that have the highest payback profitability index. So in this case, project B has a higher profitability index than project B. Project B has a higher profitability index than project A, and therefore we choose to invest in project A. Sorry, it's project B. So the decision, choose project B since it has a higher profitability index. The internal rate of return. So this is the third discounted cash flow technique. So what is the internal rate of return? So this is a discounting rate that yields an NPV that is equal to 0. The discounting rate that yields the net present value equal to 0. So the internal rate of return can be illustrated graphically as follows. So on the vertical axis, we have the NPV. On the horizontal axis, we have the discounting rate. So the relationship between the net present value and the discounting rate is a negative one. So we have that line with a negative gradient. So that means that the higher the discounting rate, the lower the NPV. And the lower the discounting rate, the higher the NPV. Yeah. So the slope of the line is constant and is negative. So you have a straight line here. And then, as per the definition, this point here, where the NPV of the project is 0, this point here where the NPV of the project here, the NPV is 0, we have the internal rate of return. So by definition, we say that the internal rate of return is the discounting rate that yields an NPV that is equal to 0. So in this line, in this horizontal axis, we have the discounting rate. So where the NPV is 0, the discounting rate there is equal to the internal rate of return. So how do we get the internal rate of return? So finding the internal rate of return. So to find the internal rate of return, we normally use the trial and error method to identify two discounting rates. That is one, a low discounting rate that yields a positive NPV. So you say that the lower discounting rate, the higher the NPV. And vice versa. So we identify a low discounting rate that yields a negative NPV, and also identify a high discounting rate that yields a negative NPV. So once we have those two, then we can get the internal rate of return of a project. So how then we need to apply a formula to get the internal rate of return of a project. So how do we get the internal rate of return of a project? So in this case, back to our graph, the slope we said is constant. So you all know that to get the slope of a line, we take the change in the y-axis divided by the change in the x-axis. The change in the vertical axis divided by the change in the horizontal axis. So in this case, if we get the change, the gradient of this line, we'll be able to get the internal rate of return. We'll be able to determine this point here. We're able to determine this point. So the slope of a line is equal to the change in y over change in x. So we can therefore say that the slope from this point here to this point here is the same as the slope from this point here to this point. And it's the same as a slope from this point to this point. Yeah. So we can say that the slope of a line is equal to the change in y-axis divided by the change in the x-axis. So in our case, the x-axis, the horizontal axis, the vertical axis gives us is the NPV. The horizontal axis is the discounting rate. So therefore, the slope of this line is equal to the change in NPV divided by the change in the discounting rate. Yeah. So therefore, we see, so this is the same as the NPV of LDR minus the NPV of IRR is equal to the lower discounting rate minus the internal rate of return. So here, so this point here. So the NPV of the lower discounting rate minus the NPV of the internal rate of return divided by the lower discounting rate minus the internal rate of return. So gives us this equation. Is equal to, or is the same as, the NPV of the lower discounting rate minus the NPV of the higher discounting rate divided by the higher discounting rate divided by the minus the lower divided by the lower discounting rate minus the higher discounting rate. So this equation is equal to this slope. So this slope is equal to this slope. So therefore, we have this equation. So for us to get the IRR, we make the IRR the subject of this equation. So the subject of this equation, this IRR as the subject of this equation, we end up with this. We end up with the lower discounting rate plus, in brackets, the NPV of the lower discounting rate minus the NPV of the higher discounting rate divided by the NPV of the lower discounting rate minus the NPV of the higher discounting rate multiplied by the higher discounting rate minus the lower discounting rate. So this is the same as this. Yeah. So in this case here, we do away with the NPV of the internal rate of return, because as per the definition, the NPV of the internal rate of return is equal to 0. Yeah. So therefore, we do away with the NPV of the internal rate of return. So therefore, our formula for the internal rate of return shall be simply equal to that one. That is the lower discounting rate plus, in brackets, the NPV of lower discounting rate divided by the NPV of lower discounting rate minus the NPV of higher discounting rate multiplied by higher discounting rate in brackets minus the lower discounting rate. So you can apply this for our question. Yeah. So we said that we use trial and error to identify two discounting rates, whereby we have a lower discounting rate that yields a positive NPV and a higher discounting rate that yields a negative net present value, or NPV. So the decision criteria under IRR. So with IRR, in case you have many projects, we prefer the projects with the highest internal rate of return. So therefore, the higher the IRR, the better. And if we only have one project to invest in, to consider, we accept the project if the IRR is greater than the discounting rate. So if the IRR is greater than the discounting rate of the project, we accept the project. But if the IRR is less than the discounting rate, we reject the project. So we reject a project if its IRR is less than the discounting rate. The IRR of project A. So we tried various discounting rates that will give us a negative NPV and a positive NPV, and then you get the IRR. So for project A, we remember the key items there. There was an initial cash outlay of 10,000 shillings. We have an annuity of 4,000 shillings. The number of years of the project is 5 years. So in this case, we are at first we try a discounting rate of 30% and see what NPV it gives us. So in this case, when the discounting rate is 30%, the NPV shall be equal to the annuity times the present value interest factor of the annuity at 30%. That is 1 plus, in brackets, 1 plus 0.3 or 30% raised to the power of -5 divided by the interest rate of 0.3 minus 10,000. It gives us a negative NPV of 257.72. So we've gotten our negative NPV. Then, therefore, we try a lower discounting rate to give us a positive NPV. We try 29%. So with 29% discounting rate, the NPV shall be equal to the annuity times in brackets 1 plus 1 in brackets 1 plus 0.29, that is 29%, raised to power of -5 years, divided by the interest rate of 29% or 0.29 multiplied by 4,000 minus the initial cash outlay of 10,000. It gives us still an NPV of -68.0178%. A negative NPV. So we still have a negative NPV. So we try another lower discounting rate. Here we are looking for another a positive discount NPV, so that we can get the. We are looking for a lower. We are looking for a discounting rate now that will give us a positive NPV. So we go for a lower discounting rate. So in this case, 28%. So we get the NPV, that is 4,000 times the present value interest factor of the annuity at 28% discounting rate for 5 number of years minus the present value of cash outflow. It gives us the NPV of 128.0242. So with this, we can now get our NPV, our internal rate of return, sorry. Yeah, so we choose the rate of 28%, which gives us an NPV of 128, and we choose the rate of 29%, which gives us an NPV of 68.0178. One thing you need to note with IRR is that the internal rate of return will change depending on the rate that you use. So say, for example, if we use 30% with its negative NPV of 257.72 and 28% and its NPV of 128.28, we'll get a different internal rate of return as opposed to when we use the rate of 29% with an NPV of -68. So we get different, multiple internal rates of return. That's one of the major disadvantages with IRR, is that it will give us multiple internal rates of return. Yeah. Now, since we are human beings, we may get conflicting IRRs. Yeah? But in case you're using a software or a computer, you'll get the most accurate internal rate of return. But for our case, since we are here to understand the concept of internal rate of return, the most important thing is to understand the concept. So we shall take just one positive, one low discounting rate that gives us a positive NPV, and a high discounting rate that gives us a negative NPV, and apply that in the formula to get the IRR. So the most important thing for us as students is to understand the concept. Yeah, to understand what is IRR. For the accuracy things, let the computers do that. But the most important thing is to understand. So in this case, we take 29% and 28% and their respective NPVs. So you apply that in the formula, and we get the NPV of project A is it's not the NPV, but the internal rate of return of project A is 0.2865, or rather 28.65%. And then for project B, we also use trial and error. We identify 2 discounting rates that give us a negative NPV and a positive NPV. So we try the NPV at 32% discounting rate. So the NPV is equal to the present value of cash inflows minus the present value of cash outflows. So we multiply each cash flow by its present value interest factor. So in our case, for year 1, the cash flow was 6,000 shillings, yeah, times the present value interest factor of year 1 is 1 plus 32%, that is 1.32, raised to the power of -1, plus the cash flow of year 2, That is 3,000 plus 0.32 raised to the power of -2 plus the cash flow of year 3, that is 2,000 times 1.32, that is 1 plus 32% raised to the power of -3 years, plus the cash flow of year 5, 5,000 times the present value cash, present value interest factor, that is 1 plus 0.32 raised to the power of -4, plus the cash flow at year 5, that is 5,000 times 1.32 raised to the power of -5, minus the present value of cash outflow, that is 10,000 shillings. Yeah, this one there's no need to discount, because it will be in case we discount this, 10,000 times 1.32 raised to the power of 0. Anything raised to the power of 0 equals to 1. So there's no point of discounting 10,000. So working out this, we get an NPV equal to 31. That is 1.3934. So you get this NPV at 32% interest rate or discounting rate. So we have our positive NPV. Therefore, now our intention is to get a positive NPV. To get a positive NPV, we try a lower discounting rate. So we try a higher discounting rate. So we try 31%. So that 1%, which gives us an NPV of 211.765, which is a higher NPV. Okay, yeah, since we tried a lower NPV, a lower discounting rate, it has just given us a higher NPV. So our intention is to get a negative NPV. So we try a low. Our intention is to get a negative NPV. So we try a higher discounting rate. So in this case, we go high. We go up. We try 33% instead of 31 or 32. So we try 33%. We get the NPV. The NPV in this case is 143.2249. Once we have the negative NPV and the positive NPV, we can now get our internal rate of return. So we use the rates that give us the closest NPVs. So in this case, is the rate of 32%, which gives us the NPV of 31.3924. So we use 32 rate and 33 and the respective NPVs, which will give us, applying the IRR formula, we get the internal rate of return as 0.3218. So the internal rate of return of project B is 0.3218, whereas the internal rate of return of project A is 0.2865. So we therefore go with project B since it has a higher internal rate of return. Thank you.